Recession fears are driving a global market sell-off after Friday's disappointing July jobs report. Investors are concerned the Fed has pressed the brakes on the economy by too much for too long. Through high interest rates in hopes of stifling inflation, which will cause the economy to enter into a recession, the Dow plunged more than 1,000 points. The Nasdaq lost 576. The S&P 500 gave back 160. And tomorrow, we'll get a better idea of how some major corporations are holding up. As for how these falling stocks may impact your life, Brent.
Yeah, joining us now to talk about the ramifications and the impact of all this instability is Dr. Eric McAlley of Quinnipiac University. So, Professor, thank you for being with us this evening. Typically, for most people under 50 who are contributing to a 401k, the answer is you're playing the long game, just let it ride. Still true?
Absolutely still true, yes. Statistics prove that out over long periods of time.
Yeah, so this is a bigger concern for people who are closer to retirement. So what should someone who's 56 or 58 or 60 years old keep in mind right now?
I would say the first thing, honestly, is that they should really look at their current allocation as opposed to moving things around at the moment. Just look at their current allocation. How are they allocated to equities, for example, versus bonds versus maybe short term? And then assess their situation in terms of when will they need the money, how much do they have, et cetera. So that's an important thing to reach out maybe to a professional look at that, to just make sure your allocation is right. The allocation seems right. I would say that they probably don't have to do too much. Yeah. If they're super heavy equities at this point, then they may want to think about talking to somebody about moving that around a bit.
So let's talk about what's happening here. As we said, this is thought to be about fears of a possible coming recession. What's the current thinking? Might we be at the start of a deeper recession? A lot of people have been predicting a big correction for a long time.
Yes, that's true. The economic data has certainly slowed over the last, frankly, over the last year. It moves up, it moves down, it gets better, it gets a little bit worse. I think over the last week or two, we've had a lot of things happening. One is, of course, the employment report we had on Friday was quite negative. There's a lot more people applying for unemployment benefits as well. But plus, we have a little bit of turmoil overseas of late, right? That's been spiking. Sure. And in addition to, the variability around the election. So in terms of being in a recession, I would say we were at a point where we really need to start paying attention, if that makes sense.
Sure.
We should support them.
It is interesting, some of the stocks that are down, NVIDIA, which had been hot as a firecracker for a couple of years, Apple, Tesla. Any explanations as to why tech stocks are dropping?
Yeah, a few reasons, I think. But I think the biggest one is that they've been on such a tear of late, and they were arguably overpriced. Yeah. And if you are going to sell some of your shares, you're going to sell the ones that are overpriced, and you have a big gain in. Right, that's one explanation.
Sure. And just one last question here. Do you think it would, or at least, or will, help the market rebound if the Fed would, in fact, start dropping interest rates this year?
Yes. Now, there's an expectation. Stocks usually move on expectation. So most sophisticated investors expect the Fed to lower the rates, let's say September, October. So if there's a big deviation to that expectation, then stocks could move. I think some people are starting to call for the Fed chair to maybe do it a little bit earlier, and if that creeps into the expectation, it could be a bit more volatile.
Okay. All right. Well, Dr. Eric McAlley of Quinnipiac, thanks for sharing your time with us tonight. We appreciate your expertise.
Thank you for having me. Appreciate it.
All right.